All right, so the assignment for round 1C. Question 1, it says suppose, so we get into some leverage questions here, but it says suppose Digby wanted to reduce its leverage ratio, because Digby's leverage ratio is just a little too high, okay, for my scoring. You know, I'm not going to tell you that having high leverage is not a worthwhile thing to have in a game like this, especially at the front end, because you got a rapidly growing industry. I mean, you're growing, what, at average of 13, 14% per year, okay? Having leverage is not a terrible idea, okay? But having leverage is also risky, okay? And so that's the only reason the penalty is assessed. When I do assess that penalty is because having leverage is risky, even though it might be a good idea. So suppose Digby wanted to reduce its leverage ratio at the end of round 1 by using cash to pay down debt. Okay, what amount would have been necessary for Digby to achieve a leverage ratio? And the game uses assets divided by equity, okay, for their leverage ratio. We in banking, we used it, debt to equity, kind of was oftentimes what we used, which is really your right side of your balance sheet, you know, and we like to look for 1-to-1, but whatever. So 2-to-1 on assets, actually a ratio of 2-to-1 assets over equity would be the same as a 1-to-1, okay, debt to equity ratio, which we used in banking. So it's taken me a while to get used to this. So the equation is leverage is equal to assets divided by equity, right? Okay, and so what amount, if they were to use cash to have paid down debt, how much would they have had to have done that by, right, in order to achieve a leverage ratio of 2? Because they were at 2.3, if I'm not mistaken. Okay, so leverage ratio 2 is equal to blank over blank, right? Okay. If you keep in mind I'll give you a little hint, I guess, because I'm sure I'll have to come around and tell everybody maybe anyhow, but keep in mind, right, your equity isn't going to change, right? If you pay down debt, if you use cash to pay down debt, you're lowering your assets and you're lowering your liabilities. So your equity is going to change, stay the same then, right? Okay. So you got 2 legs of the 3-legged stool then entered in there, so your job's just going to be able to find out what that 3rd leg is. Okay. 2, how much money did Erie leave on the table in the low end? And I want you to only look at the product ebb, okay, because their traditional products sold a little bit in the low end, but that would complicate it a little bit, because then you'd have to calculate 2 products, and I know I've had you do that in the past, but we'll keep it a little bit simpler here. Okay, so how much money did Erie leave on the table in the low end, product ebb only? In other words, net after taxes, how much more could Erie have made if ebb had sold to its potential? So this is that same question that I've asked several times, right? The actual versus potential had we sold, okay, right? Figure out the percentage, figure out the demand, figure out the total number that they could have sold in units, okay? Then you got to figure out the marginal variable cost, right? Okay. Take the units times the gross profit per item after you figured out the marginal cost and subtracted that from the price, on and on and on, okay? Then you have to apply the tax rate. And the tax rate's given to you in the guide. You can also figure it out, right, from the, okay? I mean, we can figure out the tax rate right from our income statement. Okay. So, what you'd have to do is take, let's take a company that's profitable, Andrews. So they had 19.3, right? 6.7 in interest. So they had 19.3 in EBIT, which is earnings before interest and taxes. Take off our interest from there, and so they had 13, 12, what's that, 12.5? Roughly 12.5 in earnings after interest, right? Or earnings before taxes, that would be. Okay, so earnings before taxes were about 12.5, and their taxes were about 4,400, or 4.4 million. So you could calculate the tax, whatever the tax ratio is, by that. Okay, round it off. It's supposed to be an even number. You know, when you do that math, it may be off a little bit, but round it off. But it's also in the guide. It tells you what the tax rate is in the guide. So however you guys want to determine that, that's fine. Okay, 3. Ferris is forecasting sales next round in the high-end segment. It is estimating that it will sell 490 units of Fist, its high-end product. Ferris wants to have an extra 10% of units on hand above and beyond its forecast in case sales are better, right? So it wants to have 10% more than 490, okay? It wants to make that much more, okay? So if it sells the 490, that's what it would have left over at the end of next year, right? Okay. It would rather risk the possibility of a little excess inventory rather than risk the profits on a stock out, okay? And that's what you're going to calculate. Number two is what the stock outs cost you, right? And so having a little extra inventory can sometimes be maybe a smarter choice. Taking current inventory into account. So Ferris does have some current inventory for its product Fist. Okay. What will Ferris's production need to be in order to have a 10% reserve of units available for sale? And then I put in there bonus for including the adjustment. There's an adjustment calculation that comes in your production when you guys make your production decisions. So if you take a look at that and you want to calculate what the adjustment would be, meaning that there's a certain number that they need to produce, but they might have to produce a little bit more than that because of the adjustment. And then 4, what was the cost, what was the cost, and I put in parentheses, total expense, okay, of Erie's emergency loan. I said, or Baldwin, let you figure out each. They should be pretty close, okay. There's 2 expenses that are involved in that, okay. There's the normal expense of a loan, which for loans, what's your normal expense associated with a loan? What's that called? Interest, yep. Okay. And then emergency loans tack on a little added expense. And I'll let you look that up in the guide. But Uncle Al, you could look for Uncle Al. You could search the guide and find they even refer to it as Uncle Al. Okay? Because Uncle Al's got to come through and cover for you guys because you didn't do a good job of managing your cash. But Uncle Al's going to take his pound of flesh, right? Okay. Questions about the assignment at this point? And I'll be happy to help you guys. All right. You're always wanting me to post the assignment. Gosh, I tell you. Yes, I will.